Hello and welcome back to Dukascopy TV. I'm Natalie MacDonald. Joining me now in the studio is Robert Davis, co-portfolio manager of the ING Emerging Markets High Dividend Fund. Robert, thank you so much for coming in today.
You're welcome.
Now we'll get onto the fund a little bit later, but if we start on emerging markets. Now, emerging market performance against developed markets has been slightly disappointing as investors have opted out of what they consider to be risky investments. But how and why is that changing?
Well, you're right. Over the last 2 years, EM as a class, as an equity class, has done pretty much nothing against developed markets. But I think if you look at the EM side of the equation, that's completely understandable. Effectively, what's happened is you've had, obviously, a GDP slowdown. With the economic slowdown, you've had margin compression at the corporate level, which means earnings have started to shrink. And it's a classic case of a cyclical slowdown. I think the key point that we would make is it's not a structural issue. So you do get questions about whether the whole EM investment case is broken. We don't think that's true. If you actually look at the GDP forecasts for this year, they'll probably bottom out for global emerging markets as a whole at around 4.5%, something in the 4 range. And then next year should either be stable or probably see a little bit of growth to that. And if you get stability or growth, then the same will happen to corporate earnings. And that would be the backdrop for a recovery in EM performance.
Now, one of those sort of risky markets, as it were, is China. It's sort of continued to experience a market slowdown in growth. Analysts are now starting to mull over what the state can do to manage this slowdown. Is there room for stimulus there, do you think?
There's definitely room, and one of the things that helps that is that inflation in China is very low, so they don't have the issue of trying to stimulate the economy against a high inflation rate. Whether they choose to do it or not is a difficult question to anticipate, because there are a couple of conflicting factors. When they tried a big stimulus measure after the Lehman crisis, it ended up with quite a few unintended consequences, and it's unlikely that they want to go through that again. So what you've seen so far is much more targeted stimulus at particular parts of the economy or particular industrial sectors. The other issue is actually you're starting to see a stabilization in some of the economic indicators. And so again, if they're seeing signs of a stabilization, do they really want to go through with a big stimulus package? Of course, if the economy is stabilizing, that should be a positive in itself. They shouldn't, investors shouldn't need to wait for a stimulus for that.
You mentioned growth targets earlier, and Brazil, another of the BRIC nations, has actually slashed its growth forecast for the year. Now, recent interventions and stimulus by the Brazilian government has looked to increase the role played by private investors in the Brazilian economy. Do you think that these policies are likely to work?
They're certainly well-intentioned. Our emerging markets economist has come back recently from an extended trip to the region, more positive on Brazil than he can remember being for a time. And the reason for that is when he met the policymakers, they had a very consistent message all the way through, which was essentially Brazil has to do something about the costs of doing business in Brazil, which is, if you like, the Brazilian curse. So all the measures that they're putting through at the moment, while individually they can have, they're slightly unorthodox, and individually they can have some other consequences as well. So for example, trying to lower the cost of electricity so that industry isn't crippled by high power input costs has had a very negative effect obviously on the electricity producers. But in terms of moving in the right direction, they're certainly doing that. And the signs are that their GDP should recover quite strongly going into next year. From an investor's perspective, there's potentially an issue because the market's not cheap, so it's already discounting some of that recovery. So I think you have to be quite selective in the areas that you would look at there.
If we look at EMs then on a dividend yield point of view, how does that offset then the risks that we've sort of discussed already?
Well, I don't think it's a panacea. You have to be careful about chasing yield, because just as in the developed markets, you can have some very high yielding stocks which end up being value traps or worse. In fact, a very high dividend yield is often a sign of distress rather than a sort of positive thing. But I think as you move towards emerging markets having a more stable level of growth and a more mature set of assets effectively, then you would expect dividend returns to be an increasing part of the total return that you have as an investor, much as in the same way as it is for developed markets. And in fact, there are analysis already that show that the total returns from emerging markets are largely being driven by dividends rather than capital appreciation. And as the economic growth moderates to a, say a mid-single-digit level into the medium term, that should very much be the case. The other advantage is it reduces volatility, so you get exposure to the upside, but with the dividends effectively lowering the volatility of the portfolio as a whole.
Robert, thank you so much for joining us today.
Thank you.
That's all we've got time for right now. However, for all of your technical analysis and more exclusive interviews, stay tuned to Dukascopy TV.